Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent action has, more or less, been captured within the two explosive days ranges back in late February between 1579 to 1759. Since then, despite an initial but now defunct bull channel, we've seen the market edge lower in a 2 steps up and 3 steps down action, such that 3 weeks ago we saw a test and breach of the support band 1579 to 1571 and prices briefly tested down to 1560. Now this 2 steps up and 3 steps down action had left the door open for the late February to early April action to be a descending triangle pattern. A few things first before I go any further. This descending triangle is by no means a perfect example of such a pattern anyway, but there are significant elements there that makes the action a viable opportunity. Next, we actually have 2 descending triangles in the offing, one inside the other. One from late February until 4 weeks ago, with the recent drop to 1560 being a false break lower, and one from late February until 2 weeks ago, which includes the drop as part of the pattern. Finally, a bit of information about descending triangles. Firstly, descending triangles can break in either direction, acting as a topping action as well as a continuation action. This one in question now seems to be a possible upward continuation action. Indeed, in general, descending triangles that see a market rising beforehand, such as we have had, have something like a 6 or 7 times out of 10 chance of breaking higher. Hence, looking upwards, we have an initial primary potential target X on the top side for the smaller descending triangle pattern in the 1757 area, right where the 50% projected Fibonacci line resides, and the most recent high, and also the chance for a double top. A second fuller secondary target X1 would be in the 1810 area. Now, if instead we took a look at the larger descending triangle pattern here we would have an initial target X2 in the 1780 area, above all of that, with a secondary target X3 in the 1844 area. These last 2 targets would tie in with something I've already spoken about 7 weeks ago and repeated since. I had spoken about 3 simultaneous patterns I'd seen over the middle and end of last year and going into this year. They're all bullish. They are a rounded bottom, a large cup with handle pattern, and a scallop pattern. Now, the rounded bottom still has a primary target topside in the 1983 area, which is off the top of my daily chart right now. The next one is the large cup with handle pattern, which has a primary target in the 1910 area. Once again, this is off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern. This has a primary target in the 1836 area, again off the top of my daily chart, and interestingly, the one I have the least confidence in, even if it is the nearest. These are all, well, as I've previously said, way out there. But as we have seen plenty in recent times, lots of things that are way out there can certainly happen to be true. I would like to finish off, once again, on something I originally said in my annual review of soybeans made at the very start of 2022. Back then, I was only looking at long-term charts. And I quote, "One other idea I would like to say, let's say provisionally float by you, is it is the way early on this, but it should be worth considering, is to look at the whole of the 2020 to date action as a possible bullish halfway hesitation. In which case we might have, I say might, with due deference here, we might have a possible target X topside in the 20 1/4 area. I'll just repeat that. In the 20 1/4 area. This is way up off the top of my long-term chart, and it might sound ridiculous now. Indeed, it does sound ridiculous. But it's what I see, and I'd rather say it and maybe look ludicrous and even laughable now than be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month and likely a multi-year potential target X, so there ought to be plenty of time. Plus it all depends on what the market does when and if it meets the 2021 high at 1667 and a 2012 high at 1789. That's the end of the quote. This bigger picture idea, done at the start of 2022, is still there. Chicago soybean meal. I said here last time that we have the potential for the late January to date action being one of two patterns. First is a possible bullish halfway hesitation. Now the market has had some form on doing this, as it had constructed some bullish halfway hesitations on the way up, most recently in the mid-October 2021 to early February 2022 move. This led me to place a provisional target X1 in the 520 area just off the top of my daily chart, just in case. This turns out actually to be the case. The second possibility is to look at the same action as a topping action of some form. I was not certain what form this would manifest itself, and to be honest, I was not wholly sold on this idea, but I thought it worth mentioning at the time. You see, there's the possibility for a double or a triple top, but I doubted as to whether we'd have a head and shoulders top at the time, as the neckline back then would have needed a French curve to be accurate. However, since then, French curve has straightened itself out. We now have a not perfect, but workman-like head and shoulders top pattern. Last Tuesday, the market breached and closed below the neckline, currently at 44.20. Yesterday was the second consecutive close below it, though admittedly it was with a large indecisive spinning top. Today the market is pushed lower through the April 2020 high at 439.30 and pressing onto the significant combination of the early April 2020 high at 439.30. For the early April 2021 high at 433.5, which along with the congestion and highs from January and February 2021 has held up the progress on the closing basis. Additionally, the market is not just testing, but it's actually breaching the important rising medium moving average, currently 433.30. All this bearish pressure is being helped by this overhead head and shoulders top, such that the next significant support, should these levels finally break, will be down at the start of the year, the bullish halfway hesitation in the 422 even to 400 area. Only a pullback up and consecutive close over the short medium moving average, currently 458.70, would effectively counter such a move as we're seeing today. Watch out for that head and shoulders top. Chicago soybean oil. Of all the Chicago soybean complex, the landscape of the Chicago soybean oil and this daily chart has changed by far the most. Initially, after the change gap in March, the market worked its way higher, filling in the change gap itself. However, the previous all-time high back in 2008 at 72.67 managed to temper, if not halt, the rise on a two consecutive closing basis. Indeed, the June 2008 high at 68.97, another relic from those days, stopped the subsequent fall. Thus, it was those 2008 levels that captured the recent market until 2 Fridays ago, when the market punched up through the 2008 based overhead resistance and up to test the levels seen back in early March. Okay, so last time I put forward some pattern options. Well, options this market may have. They were for the late February to date action being a possible head and shoulders top, looking on the continuous chart. Then again, the late February to date action being a possible double top, or what was and is my current favorite actually, the mid-December 2021 to date action being a very large bullish halfway hesitation. Now, the reason for my favoring this last idea was something I pointed out last time and the time before. It is the lagging indicator of three golden crosses over February and March that produced enough of an impetus that this pattern has seemingly taken hold, and last week prices broke up through the previous all-time high, only just formed in early March, and since then we have formed new all-time highs on almost a daily basis. The latest was, well, yesterday and now today. Indeed, yesterday saw a second consecutive close over the projected 50% Fibonacci line at 81.23. Thus, it is time to look at the possible target X for this large bullish halfway hesitation pattern, and that's in the 92.90 area. I know it is a hell of an ask, but I feel obliged to suggest it. Plus, just beyond that, we have the 100% projected Fibonacci line at 94.95. The only obstacle that I can suggest in the meantime is the big Gann number, 90 even. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.